simple is not the same as easy. How can I maximize my profits? This strategy has been the most effective for me. Don't miss out. Every beginner strategy promises the same thing. One indicator, a few rules, easy money. And most fail for the same reason they tell you when to get in and nothing else. No filter for when the market isn't offering the setup. No stop logic. No definition of when the trade is dead. Today, I'm giving you a strategy that fits on a sticky note, plus the missing half. The two conditions that cancel the trade before you ever click buy. Here's the whole thing in one breath. One indicator, the 50 EMA. Price has to be on the wrong side of it. Then flip. You wait for a small pullback. You mark one horizontal line, and you enter when price takes that line out. Stop goes on a volatility-based trail. Target is double the risk. That's the strategy. The rest of this video is about the parts nobody teaches when not to take it, how to size it, and how to prove to yourself it works before you risk a penny. Part 1. What the 50 EMA is actually telling you. Before we use it, understand it, because trading a line you don't understand is how people end up superstitious about indicators. An exponential moving average is just the average closing price over a set number of bars, weighted so the most recent bars count for more. 50 periods on a 4-hour chart is roughly the last 8 trading days. So that blue line is a rolling answer to one question. What has this market considered fair value recently? Which means the signal isn't the line itself, it's which side of the line price is living on. When price spends 40 bars below the average and then closes above it, something has changed. The sellers who are happy to keep selling into every small rally have stopped. That flip is our trigger to start paying attention. Not to buy, to pay attention. There's a big difference, and it's worth about half your account over a year. One more thing to read off the line before we go further. Its slope. A 50 EMA that's pointing clearly up or clearly down is describing a market with a direction. A 50 EMA that's flat and horizontal, with price crossing it back and forth every few bars, is describing a range, and this strategy is close to useless in a range because you'll get a flip, a pullback, an entry, and then price will simply wander back through everything. If the line is flat, close the chart and go and look at a different pair. And why 50 rather than 20 or 200? A 20 EMA hugs price so tightly that it flips sides constantly, a signal every other day, most of it noise. A 200 EMA is so slow that by the time price closes through it, the move has already run for weeks. 50 sits in the middle, slow enough to filter the daily chop, fast enough that the flip still happens near the start of a move. Test other lengths later, but change one thing at a time. Setting it up takes about 20 seconds. Open your chart, click indicators, search for the exponential moving average, add it, open its settings, and change the length to 50. Leave the source on close. That's your entire screen, a candlestick chart, and one line. No oscillators, no volume profile, nothing else. If you find yourself wanting to add a second indicator to confirm the first one, that's usually a sign you don't trust the plan yet, and the fix for that is testing, not more lines. Part 2. The long setup, step by step. Right, the sequence. 4 steps, and every one of them has to happen in order. If step 3 shows up before step 2, there's no trade, you just wait for the next one. Step 1. Price has been trading below the 50 EMA, not for 2 bars. I want to see a stretch of it, 10 bars or more. So we know we're flipping an actual downtrend rather than reacting to noise around a flat line. Step 2. A candle closes above the 50 EMA. The close is what matters. A wick that pokes above and closes back below is not a flip, it's a failed attempt. And you'd be amazed how many beginners take that as their signal. Body above the line, on the close of the bar. Now the clock starts. Step 3. And this is the part that gives the strategy its edge. You wait for the pullback. Specifically, at least 2 consecutive candles pushing back against a new direction on a long, that's 2 red candles in a row after the flip. Why 2? Because 1 red candle is just a pause. 2 in a row means a genuine counter move started. Buyers took a breath, and the people who bought the very top of the breakout are now underwater and nervous. That's when the good entries appear. The moment you have those 2 candles, draw 1 horizontal line and only 1 across the highest point reached before the pullback began. That's your trigger line. Everything now hangs on it. If price can reclaim that high, the pullback failed and the new uptrend is resuming. If it can't, nothing happens and you keep your money. You've turned a vague feeling about direction into a single, testable yes or no condition, and that is the entire job of a trading plan. Step 4 is the entry. And I want to be strict about it because this is where beginners leak money. You enter when a candle body closes above the trigger line, not when the price touches it, not when the wick pierces it while the candle is still running with 4 minutes left on the clock. A close. If you're on the 4-hour, that means you might wait 3.5 hours after the level gets tagged, and yes, sometimes the trade runs without you. Take that trade-off. It's the cheapest filter in the whole strategy. Part 3. The short setup is the same thing, upside down. Everything works in reverse, and you should trade both directions or you'll spend half the year sitting on your hands. Price has been above the 50 EMA for a decent stretch. A candle closes below it, that's your flip. Then you wait for at least 2 consecutive green candles pushing back up. That's your pullback. Now you draw your horizontal line at the lowest point reached before that bounce started, and you sell when a candle body closes below it. Same structure, same discipline, opposite direction. And a small practical note, shorts on many pairs tend to move faster than longs, so don't be surprised if your target gets hit in half the time. That's not you being clever, that's just how fear moves compared to greed. Part 4. Where the stop and the target actually go. A setup without a stop isn't a strategy, it's a hope. And I don't want you guessing at a round number of pips, because a fixed stop is too tight in a volatile session and far too wide in a quiet one. So we use a volatility-based stop, the chandelier exit. Added from the indicator list, the standard settings, 22 periods, and a multiplier of 3 are fine, and you shouldn't touch them until you've tested 100 trades with them. What it's doing under the hood is simple and worth knowing. It takes the highest high of the last 22 bars and subtracts 3 times the average true range. So, in a market that's swinging around, your stop automatically sits further away. In a quiet market, it tucks in closer. It's placing your stop where the market's own noise level says it should be, rather than where your account balance wishes it could be. Your take profit is mechanical. Measure the distance from your entry down to that stop, and place your target the same distance again above your entry, doubled, 2 to 1. And here's why that number matters more than the strategy itself. With a 2 to 1 payoff, you only need to be right about 1/3 of the time to break even before costs. Read that again. You can be wrong on 2 out of every 3 trades and still not be losing money. That is what a good reward-to-risk ratio buys you. Room to be wrong. 2 management notes. First, you can trail the stop up along that same chandelier line as the trade develops. It's designed for exactly that. Just be aware you're then trading a different system with different statistics, so test it separately rather than switching mid-trade because you got nervous. Second, don't move the stop to break even the moment you're slightly green. On this setup, price very often dips back toward the trigger line before it goes, and you'd be scratching trades that were about to work. A worked example, start to finish. Let me run one all the way through with round numbers so the maths is easy to follow. Treat these as illustrative figures rather than a live call. Say we're on the 4-hour chart of a pair that's been sitting under a falling 50 EMA for about 3 weeks. On a Tuesday morning, A candle closes at 1.085 with the EMA sitting at 1.0838. That's a body close above the average, so step 2 is done and the clock starts. I do nothing yet. Over the next 2 bars, price pushes on to a high of 1.088. Then 2 red candles print in a row and drag it back to 1.0855. That's my pullback, confirmed 2 consecutive candles against a direction. So I draw one horizontal line at 1.088, the high before the pullback started, and now I have a single condition to watch. Notice the pullback stayed above the EMA at 1.0841, so nothing is invalidated. If it had closed below that line, I'd have deleted the level and moved on. 2 bars later, a candle closes at 1.0892 above the line. And it's a normal size bar, not triple the others, so neither invalidation fires. That close is my entry. The chandelier stop is reading 1.0836, so my risk is 56 pips. Target goes at double that, 112 pips above entry at 1.1004. Now the important part. I don't ask whether 56 pips feels like a lot. I ask, what position size makes 56 pips equal 1% of my account? And if that comes out at a size I find embarrassing, I take it anyway. And then, the boring bit, nobody films. I leave it alone. Stop and target are in, so watching the 5-minute chart will only tempt me into interfering. However it resolves, it goes in the journal as one data point among the 50 I need before the result means anything. One trade tells you nothing, not a comforting thought when you're down, but the correct one. Part 5. The 2 things that cancel the trade. This is the part I promised you at the start, and it's the reason this strategy has any chance of working. Everything so far tells you when to enter. These 2 rules tell you when to walk away from a setup that looks perfect, and walking away from good-looking trades is a much harder skill than finding them. Invalidation 1. The pullback goes too deep and closes back on the wrong side of the 50 EMA. Picture it. You got your flip above the line. You got your 2 red candles. You drew your trigger line, and you're waiting. But before price can take that line out, it slides back down and closes below the EMA again. That trade is dead. Delete the line. What just happened is that the sellers who were supposed to have given up came straight back in. And a market that can't hold above its own recent average has not flipped, it has bounced. And I want you to notice something about that rule. It doesn't stop you losing money on trades you took. It stops you taking trades at all. That's a completely different kind of filter, and it's worth more than any exit rule you'll ever learn, because the trade you never entered has a maximum loss of 0. Invalidation 2. The breakout candle is enormous. If the candle that closes above your trigger line is 3 or 4 times the size of the recent average candle, do not take that entry. 2 problems with it. 1. The move has already happened. You're buying the top of an explosion, and the next natural thing for price to do is give some of it back. 2. And this is the practical killer. Your stop is now miles away because the candle is huge, so your position size has to shrink to nothing, and the 2-to-1 target sits somewhere the market may never reach. How do you judge whether a candle is oversized without eyeballing it? Quick version. Look at the last 10 candles and ask if this one is obviously more than triple the typical body. If you have to think about it, it isn't. Precise version. Put the ATR indicator on the chart and check whether the candle's range is more than about 3 times the current ATR reading. Most oversized breakouts happen on news, which brings me to the filters I'd add on top. Quick pause. If the invalidation rules alone were worth the click, a like helps this reach other people in their first year of trading. And tell me in the comments which pair you'll test this on. Part 6. The filters I would add before trading this live. 3 additions, and none of them make the strategy more complicated to execute. They just narrow when you're allowed to execute it. First, the economic calendar. If a high-impact release for either currency in the pair lands within an hour of your setup completing, skip it. That's not caution for its own sake. It's because news candles are exactly the oversized bars we just agreed to avoid, and your stop will be run for reasons that have nothing to do with your analysis. Second, a time frame decision, and please make it once rather than every session. The 4-hour chart gives you fewer setups but cleaner ones and a stop distance you can actually live with. The 15-minute gives you far more signals and far more noise, and it demands you're at the screen. If you have a job, trade the 4-hour. Most beginners pick the 15 because more trades feels like more opportunity, and then wonder why their results look random. Third, a limit on how many pairs you watch. Pick 4. Learn how they behave and ignore everything else. Scanning 30 markets for this pattern will find you 30 setups a week, and you will take the worst of them. Because when you're looking that hard, you'll start bending the rules. The pullback was 1 candle instead of 2. The close was almost above the line. 4 pairs, 1 strategy, every rule met or no trade. And one optional 4th filter that I think is worth the extra 30 seconds. Check the daily chart before you take a 4-hour signal. If your 4-hour setup is long and price on the daily is also above its own 50 EMA, you're pushing with a bigger flow and you can take the trade at full size. If the daily is clearly below, you're trading a counter-trend bounce, still tradable, but I'd halve the size and I'd take profit at 1.5 times risk rather than 2, because counter-trend moves run out of road sooner. One thing people forget when they're excited about a 2-to-1 target: costs are real. On a 50-pip stop, a 2-pip spread quietly eats 4% of your risk before the market has moved. On a 10-pip stop, it eats 20%. That's the hidden argument for the 4-hour over the 15-minute, and why a strategy that looks profitable on paper can bleed out on a low time frame. Part 7. Prove it to yourself before you fund anything. Now, the bit that separates people who make this work from people who watch strategy videos forever. You do not know whether this strategy suits you until you've tested it yourself, on the pairs you'll actually trade, in the time frame you'll actually use. And I'd rather you trusted your own numbers than mine, because a win rate quoted in a video tells you nothing about how it was measured, which pair, which years, whether spread and swap were included, and whether the losing setups were counted at all. Here's the process, and it takes an evening. Open your chart, scroll back 2 years, and hide the right-hand side of the screen so you can't see the future. Walk forward, bar by bar. Every time all 4 steps complete and neither invalidation fires, log the trade date, pair, entry price, stop, target, and the outcome. Do not log the ones you'd like to have taken. Do not skip the ugly ones. That last sentence is the whole discipline of backtesting in one line. You need a sample, not a highlight reel. 30 trades is the absolute minimum before the numbers mean anything, and I'd push for 50 or more. Below 30, you're mostly measuring luck. A run of 4 winners proves nothing, and so does a run of 4 losers, which is exactly why so many beginners abandon a workable plan in week 2. Then do the only calculation that matters. Multiply your win rate by 2 because winners pay 2R and subtract your loss rate. If that number is above 0 before costs, you have something worth trading small and watching. If it's below 0, the strategy isn't broken. It's just not working on that pair in that time frame, and the fix is to change 1 variable and test again, not to add 3 indicators and hope. And when you go live small. Whatever position size feels correct, have it for the first 20 trades. You're not trying to earn during that period. You're testing whether you can follow your own rules when actual money is moving, which is a completely different skill from clicking through a backtest. Almost everybody discovers they're a worse rule follower than they thought. Better to find that out at 1/10 of the cost. Part 8. Risk, and the 4 ways people break this strategy. Risk 1 to 2% of the account per trade, and let the stop distance decide the lot size rather than the other way round. If the chandelier stop sits far away on a volatile pair and that forces a tiny position, take the tiny position. The setup does not become safer because you like to earn more from it, and no single trade in a strategy with this many signals is worth pushing on. Now, the 4 ways I see people break it. 1. Entering on the touch instead of the close because waiting feels like missing out. 2. Taking the setup when the EMA is flat because a signal appeared and doing nothing feels like wasting the session. 3. Moving the stop when price approaches it. That is not risk management. That is simply choosing to lose more later. 4. Switching strategy after a losing streak of 3, which, given a 2-to-1 payoff, is a completely normal thing to happen and tells you nothing at all. And keep a journal, even a rough one. Date, pair, whether every rule was met, and 1 sentence on what you were feeling when you clicked. Within a month, that last column will tell you more about your results than any indicator ever will, because the pattern that shows up is almost never technical. It's the trades taken on a Friday afternoon, or straight after a loss, or the one where you wrote, rules, mostly met. Mostly met is not met. Recap, and what to do this week. Let's tie together. 1. Price on the wrong side of the 50 EMA for a decent stretch, then a body close through it. 2. At least 2 candles pulling back against the new direction. 3. 1 horizontal line at the extreme before the pullback. 4. Entry on a body, close through that line. 5. Stop at the chandelier exit, target at double the risk. 6. Cancel it if the pullback closes back through the EMA, or if the breakout candle is triple the size of everything around it. 7. No trades when the EMA is flat or high-impact news is due. Your job this week is small and specific. Pick 1 pair. Set the chart to 4 hour. Scroll back a year and log 20 setups by hand. Every one that qualifies, including the ones that lost. Then look at your own expectancy number and decide from there, not from a video. Come back and put your result in the comments, win rate and sample size, and I'll tell you honestly whether it's worth taking further. If this was useful, subscribe and turn on the bell. There's a new breakdown every week, and the next one takes this same setup and shows you how to hold the winners longer instead of taking 2R every time, which is where most of the money in trend strategies actually is. Thanks for watching, and I'll see you in the next one. And the important bit, this is education, not financial advice. Trading carries risk, and you can lose money. Nothing here is a recommendation to buy or sell anything. No strategy has a guaranteed win rate, and any past results, mine or anyone else's, do not predict future ones. Manage your risk 1 to 2% per trade, and test everything on demo before it touches real money.